Okay, let's dive into this. Every single valuation model, whether you're pricing a mature tech giant or super volatile emerging market startup, well, it rests on one fundamental number, and that is the risk-free rate. It's literally the bedrock of corporate finance. If you get this baseline number wrong, your entire discounted cash flow model completely collapses, and every subsequent calculation you make is going to be skewed. Welcome to The Explainer. Today, we're looking at Aswath Damodaran's framework for practically estimating riskless rates. We're going to cut right through the heavy theory to give you the actual actionable tools you need for accurate valuation. Here is our roadmap for today. 1. Defining the risk-free rate. 2. The standard market approach. 3. Real versus nominal rates. 4. Dealing with sovereign default. And finally, 5. Practical estimation techniques. All right, let's get into Section 1, defining the risk-free rate, and specifically the 2 non-negotiable rules. It's absolutely vital to understand that risk-free isn't just some casual label we slap onto a safe investment. It is a very strict mathematical condition. For an asset to be truly theoretically risk-free, the actual return you end up getting must always perfectly equal the expected return you modeled. No surprises. To achieve that level of certainty, 2 non-negotiable conditions have to be met. First, there must be absolutely zero default risk. Now, this effectively wipes out all private and corporate securities right off the bat, because even the safest, most pristine blue-chip companies have some tiny sliver of default risk. Second, and honestly this is the one most people totally forget, there can be absolutely no reinvestment risk. To really grasp why reinvestment risk matters so much, say you're valuing a 5-year project. Now, you might be tempted to just grab a 6-month U.S. Treasury bill as your risk-free rate, right? Because, hey, it has zero default risk. But if you do that, you are wide open to reinvestment risk. You have absolutely no idea what the prevailing interest rate is going to be when that bill matures in 6 months, and you're forced to reinvest that cash. So the true theoretical ideal here, it's a 5-year zero-coupon bond. It matches your project's timeline perfectly, and it guarantees the return over the entire life of the project without ever forcing you to reinvest intermediate coupons. Moving on to Section 2. The standard market approach, or how we operate in ideal conditions. Okay, so in developed, stable markets where governments fully control the printing of their own currency, we're operating under ideal conditions. Here, we rely heavily on what Aswath Damodaran calls the consistency principle. He notes that the risk-free rate you use to come up with expected returns should be measured consistently with how the cash flows are measured. So, the crucial point is this. Your discount rate and your cash flows absolutely must speak the exact same language. If you're estimating your cash flows in nominal US dollars, your risk-free rate has to be a nominal US Treasury bond rate. If you're doing it in Swiss francs, you must use a Swiss franc risk-free rate. It has literally nothing to do with where a company happens to be headquartered. It's entirely about the currency in which those cash flows are estimated. Next up, Section 3, real versus nominal rates, and dealing with the massive complication of inflation. So what happens when the currency itself is a moving target? Look, in economies that are dealing with high and unstable inflation, relying on nominal rates is just a recipe for disaster. The expected inflation component baked into the interest rate is so volatile that it completely distorts the true value of the asset. The solution here is pretty clear. When inflation is highly unstable, analysts have to switch over to real valuations. You literally have to strip expected inflation completely out of your cash flow estimates, and then you discount them using a strictly real risk-free rate. So how do we actually pull that off? How do we estimate a real risk-free rate, especially if a country doesn't even issue its own inflation-indexed bonds? Well, you've got 3 primary methods. Number 1, if they are available, just use inflation-indexed treasuries, like U.S. TIPS, because they guarantee a real return. Number 2, you can rely on the global capital flow argument. The idea here is that if capital flows freely across borders, real rates should equalize globally, meaning you can just plug that U.S. real rate in pretty much anywhere. And number 3, if there are market frictions that prevent that free flow of capital, you can essentially estimate that an economy's expected real return should roughly equal its expected real growth rate in the long term. Let's move to Section 4, dealing with sovereign default. This is the classic emerging market dilemma. Now we're officially stepping into the deep end. This is the ultimate headache for any valuation analyst. What if there is simply no default-free entity? What if the local government, even when borrowing in its own local currency, is actually perceived by the market as a default risk? Our entire premise so far has been built on the idea that government bonds are inherently safe. If they aren't, You can't just blindly take a 10-year emerging market government bond rate and plug it in as your risk-free base. You just can't, because that rate is already contaminated with risk. Which brings us to Section 5, Practical Estimation Techniques. Let's call this the Pragmatist's Guide. When the clean, theoretical rules of finance violently collide with the messy reality of global markets, we need actionable math. Our first practical workaround relies on sovereign bond ratings from agencies like Moody's or S&P. These ratings actually correspond directly to measurable default spreads. So a top-tier or AAA rating has a 0% spread. The market views it as truly default-free. But drop down to a Bay2 rating, and historical market data reveals an estimated default spread of 2.40%. That spread is the exact, quantifiable premium that investors are demanding just to take on that government's default risk. And this brilliantly illustrates how we apply that spread in actual practice. Let's take a valuation scenario over in India. If the Indian 10-year government bond is yielding 8%, well, that 8% already includes risk, because India carries a B2 rating. To find the actual sanitized risk-free rate in rupees, we simply subtract that 2.40% default spread. The math is that simple. This leaves us with a true underlying risk-free rate of 5.60%. Now, what's really fascinating about this approach is that we can actually make it even more dynamic. Let's look at the Brazilian real as an example. Here, instead of a static rating, we can tap into the credit default swap, or CDS market. This is basically a market where investors actively buy insurance against a sovereign default. And because it's traded daily, it gives us a real-time, highly updated default spread. So if the 10-year Brazilian government bond is sitting at 8.25% and the Brazil CDS is currently trading at 0.75%, we just subtract that CDS spread. The result? A 7.50% risk-free rate in Brazilian real. It is way faster to react to real-time economic changes than a sovereign rating, though you do have to be a bit careful because CDS markets can be notoriously volatile. But let's push our pragmatism to the absolute limit here. What happens when a country's financial markets are so constrained that the government doesn't even issue local currency bonds at all? Or what if they technically exist, but they just don't trade liquidly enough for us to actually trust the interest rate? What do we do then? If you literally have no local bond to use as a baseline, you switch to the build-up approach. This is pure fundamental synthesis. Step 1, you start with a globally trusted real risk-free rate, something like the interest rate on a U.S. inflation index treasury bond. Step 2, you determine the expected inflation rate for your specific target country. And step 3, you simply add them together. By stacking a solid global real rate right on top of local expected inflation, you synthesize a perfectly sound, logical, local risk-free rate built entirely from the ground up. All right, let's quickly summarize with our practical takeaways so you can put this to work. When you're estimating these rates, keep these 4 pillars locked in your mind. First, theoretically, you have to demand 0 default and 0 reinvestment risk from your baseline. Second, always anchor your work to the consistency principle. Your currency and inflation assumptions for cash flows and discount rates must match perfectly. Third, when you're evaluating emerging markets, be aggressive about backing out those sovereign default spreads using ratings or the CDS markets. And fourth, don't panic if local data is just missing. Just rely on the build-up approach to synthesize your rate. Ultimately, valuation is fundamentally about how we choose to price safety and uncertainty. The entire framework we've explored today relies pretty heavily on the assumption that certain developed governments will simply always honor their debts. So I'm going to leave you with this final thought to chew on. As global economies continue to shift and traditional financial powerhouses start facing new, unprecedented debt realities, what assets will be considered truly risk-free a decade from now? Will the U.S. Treasury remain the undisputed, unquestioned baseline, or will shifting market dynamics literally force us to rewrite the rules of valuation entirely? Think about that the next time you drop a discount rate into your models. Thanks for joining me on this explainer, and I'll see you next time.